Thank you, Ashley. Good morning, everyone. I'm glad you could join us. I think Ashley had mentioned earlier that our previous webinar was placed on their YouTube site, which I've already reviewed. This one will be added to it so that if you have an opportunity, you can go back and review both parts of our mini series on qualified plans. For those of you who did not see the prior PowerPoint presentation, I invite you to go give it a review, give us a call. We are right now at the point in the year where if some small business owner that's making a lot of money and is anticipating paying lots of taxes, this is the time to pick up the phone, give me a call, and discuss how we can potentially help them reduce their tax liability. I can tell you right now that we're sitting on dozens of cases with brokers just like you from all across the country that have cases that we're waiting to get the documents signed, get the insurance applications written, get other investment products lined up or annuity products lined up. And so the potential for doing qualified plan business has never been better, particularly with what the government plans on doing as far as taking more money from us and small business owners who work very hard to create profits in their business are looking for opportunities to reduce their potential tax liability. So with enough of my advertisements, if you all use different qualified plan people, by all means, feel free to give them a call and discuss it with them. My goal is to just try to educate you as to the possible opportunities that exist. Well, why do we do this? Well, qualified plans are great financial tools, but they're even better when you buy life insurance inside of them because they provide a death benefit, which can be particularly beneficial to the beneficiaries of the family or the owner of the business. Throughout my career, and it's been a long one. I've been doing this for over 40 years, and I've had to deliver a lot of death claim checks. But the ones that are the most meaningful to me are always to the wife or widow and those with children. So what we want to try to do is show you additional ways to help sell life insurance to your clients. And you don't necessarily have to have a pension plan with us, although we'd love to have you. If you have clients with pension plans, we're going to show you how to add life insurance into those plans, okay? Because it's a very tax efficient way to pay the premiums. If you had your choice, would you rather pay your house payment or your car payment with tax deductible dollars? I'm sure you would. Well, it's the same thing with life insurance. You can buy your life insurance with tax deductible dollars inside of a qualified plan, whether that's a profit sharing plan, a defined benefit plan, a fully insured plan, a cash balance plan. The only place that we don't recommend necessarily that you put life insurance is in a 401k plan, at least in the 401k portion of the plan. In the profit sharing part of the plan, you certainly can do that, and we encourage that, especially if you have the people have pretty decent account balances there. What a great way to round out the benefits is using part of the money that they've accumulated to purchase life insurance. So buying life insurance protects families in the event of an early death, and it may increase the tax deduction in defined benefit plans, depending on the kind of defined benefit plan that we're talking about. Buying life insurance enhances the benefits. What would happen if the business owner died before reaching retirement? Without the life insurance, all the beneficiary is going to receive are the current values of the contributions made to the plan and any interest that they've earned on it. Now, some of you are probably pretty good money managers. You may be good investment people, but the fact of the matter is that if you could take 10 or 15 or 20% of the value of the qualified plan and purchase life insurance, that is a pretty significant investment in protecting the family against the unfortunate happening of the loss of a loved one. Okay. Now, That death benefit, by the way, when it comes out of the plan, is mostly income tax free. So we want to make certain that we understand that not just buying life insurance with tax deductible dollars, but there are big benefits for the beneficiaries when they receive those death benefit payments. I don't know what I did, but I did it. So something's not working here. So let me go over to here. All right. Just bear with me a second. My the young lady that
just
we
come off the presentation.
Yeah, I don't know what I touched a button and now I'm on the side panel.
Go, here's what you do. On the bottom of your screen, you're gonna see there's a to the bottom right, you're gonna see you are grayed out over the agent view. Change it to the little book, the little 2-page book view.
Aha.
That
You can, Ashley, thank you very much. And all of you can see why I'm good at pensions, but not so good on the technicalities of the computer.
Is it pulling up?
Yep, sure did.
Okay, on our side, it's still showing the other one, the other view.
All right, let me see. Did it change?
It did not.
Oh my, hang on one second. Okay. Take a 2-minute break while I go retrieve the other half of this team.
I think it's supposed to be that one.
They can't see this. I somehow went off screen.
Yeah, we are seeing like the actual PowerPoint.
The two sides,
yes.
Why life insurance and then premiums are paid with tax deductible dollars.
I'm not even saying that. I'm just saying the first slide.
Oh, yeah. Can you see this? Just the first.
It's not changing. There it goes. Premiums are paid with tax deductible dollars.
Yeah, okay. Okay.
Why life insurance?
There you go.
Perfect. All right, I'm going to go back on mute.
Thank you, Ashley. Thank you, Danielle. Danielle's my daughter, by the way, and she's usually in here with me when I'm doing these things. She doesn't trust me to be able to push the button. But we do try to have fun while we're doing these things. I hope we haven't offended anybody with with my ineptitude. But buying life insurance in a qualified plan is an extremely important issue that you just have to sit back and take a look at it. If the business owner is not only the one depending on their retirement income, because in the event of a premature death, life insurance fills the gap. Okay, there's special opportunities in profit sharing plans to fund key person insurance, buy, sell, second to die coverage, or coverage on a non-working spouse. Very few people in the insurance business that aren't involved in pension plans understand all the different things that you can do with values that have built up inside of a profit sharing plan. So, take a step back and keep that in mind. And if you need more clarification on it, we can certainly talk about it in just a second. I'm praying to goodness that I can keep my finger on the right button and we'll move forward. Okay, premiums are paid with tax deductible dollars. Here's your opening. If you want to talk to somebody, I have my elevator speech. My elevator speech is, are you happy with the amount of taxes you're paying? I've yet to meet anybody who honestly gave me an answer of saying, yeah, I really like paying my taxes. Well, it's the same thing with this. Okay. Would you rather buy your life insurance wholesale or retail? Okay. If you buy it in a qualified plan, you're buying it wholesale. So you're using the premium dollars pre-tax to purchase the insurance. So if you were going to buy a $100,000 premium and you're in a 30% tax bracket, it's going to cost you $130,000 to buy that policy. But if you had $100,000 sitting in your qualified plan and it fit all the other regulations, you could only spend $100,000. There'd be no taxes because that would be an investment of tax deductible dollars. All right. Some additional reasons for buying life insurance is the state tax exemption if paid to the plan's participating surviving spouse using the unlimited marital deduction. Folks, I don't know if you have wealthy clients, but if I had anybody who had significant net worth, I would certainly be talking to them about all of the stuff that's being planned on in Washington to get their tax dollars, to get your tax dollars, to get my tax dollars, to increase the tax dollars that we're all paying and or going to be paying if some of the legislation that's being proposed gets passed. The trillions and trillions of dollars of debt that the government is adding to our country is going to be paid on the backs of us, hardworking people out to try to take care of our families, the business owners who are trying to take care of their families and their employees, and all of the other unsuspecting folks that are going along every day, not paying attention to what's happening in Washington, are going to be blindsided. And what we want to do is try to prepare you to be able to take advantage of making sure your clients are aware of the things that they could do. And let's say, for example, that we made these kind of proposals or discussed these kinds of issues with your prospects, and the government doesn't pass all these things. Maybe some sane people in Congress stopped it all from happening. What's the worst thing that could happen? Is you ended up doing a good thing for your client and their families, and they will still get the tax deductions that you had promised them. It just may not have as big of an impact if the legislation were not passed. I'm just sitting here telling you today that based on my history and looking back over my career, there have been a lot of changes in taxation and the attacks on small business and on estate taxes. You know, there's a provision right now that if currently there's about $11 million estate tax exemption for each of husband and wife, but that's going to drop down to 4 million in 2026. If the government has their way, they want to drop that down even lower, and they want to do it a whole lot faster. So now is the time to talk to your wealthy clients, talk to your small business owners, successful small business owners, and talk to them about ways to purchase that insurance on a wholesale basis now before it's too late. Okay? Because life insurance premiums paid inside a qualified plan, they're tax deductible to the plan sponsor, even when a plan participant receives a substandard rating. I'm dealing with a case right now where we don't believe that one of two business owners are going to be able to be insured because of his prior health history. We're going to be able to give him annuities, but we're also working with our friends at Fortress Brokerage to try to provide him with some type of insurance coverage, perhaps through guaranteed issue, maybe through some other kinds of techniques that can be done. Maybe they can't be done inside of the qualified plan, but if we can provide death benefits so that this man and his family would have the added protection. These are the things that we as insurance professionals try to do all the time. So what we want to try to do is just shift the risk from the individual, from the business owner to the insurance carrier, whomever that insurance carrier might be. We want to allow them to be the risk takers, not our clients, not our business owners. In some cases, life insurance creates a much larger deduction in a defined benefit plan, particularly in a fully insured defined benefit pension plan. If I had two gentlemen ages 50 and one was insurable and one was not, the one that's not insurable, the only thing we can put inside of that plan is an annuity or maybe other investments if it's a traditional defined benefit plan. But if we used a fully insured defined benefit pension plan, assuming they were the same age, there's going to be a much larger deduction for the individual who is insurable that's going to be able to provide a large benefit to his family, get a larger tax deduction for his company, and he's going to be a happy camper. His partner, not so much. His partner family will get the benefits that are paid out from the annuity, but that's it. No additional death benefit from life insurance because they couldn't qualify. Qualified plans can be used to purchase life insurance policies and pay the premiums for several years. At an appropriate time, policies can be transferred out of the plan at a fair market value. Well, who determines what a fair market value is? Well, there are firms out there who specialize in coming up with the fair market value of a particular plan if a plan participant wants to move their insurance policy out of a plan. Okay. One of the things that we try to do in an advanced planning technique is I'm right now working with several very successful business owners, and we're purchasing large amounts of life insurance inside of their qualified plans. But at the same time, we're helping them set up an irrevocable life insurance trust. And we're funding that life insurance trust with enough gifts to equal the cash value when the plan is ready to terminate. Because what we're going to do is we're going to have the irrevocable trust buy the life insurance policy for those cash values and move the life insurance out of the estate into the irrevocable trust. A lot of people don't know that you can do that, but it is a very, very good advanced estate planning technique where you combine both the pension and irrevocable life insurance trust to give your client double tax savings, both current income tax savings and later estate tax savings. So you want to do these things, you want to talk about them, you want to find the appropriate way to bring these subjects up. Anything can happen if you ask the right questions. Going out and talking to successful small business owners, which is what my practice is primarily all about, whether they're doctors, lawyers, CPAs, small business owners. I mean, I got to tell you, I've got small business owners that do some very, very unique things. Okay. They have very successful businesses on topics that I can't mention on here because it's private, but I can just tell you that there are things that you would never think of. Trucking companies, garbage disposal companies, distributors, retailers, you name it, we've done it. People who sell tires and change tires and do all that kind of work, all good prospects if they're making money and paying taxes. Over my career, I've insured just about anything and everything you can think of, from print shop folks to dry cleaners to clothing manufacturers. There's no limit to the size. We've got cases right now in for design on, well, one census that I just sent in last night is there's 1,000 people in the census, but only 40 of them are full-time. So just because a company's got lots and lots of employees doesn't necessarily mean that it's not a good candidate, because out of those 1,000 people, only 40 of them are full-time, and several of them are high-end income owners, and their net worth is significant. So we've got lots of planning opportunities. So just take a step back and look at your book of business and say, who have I got out there that may fit any of these types of situations? And if you'd like to talk more about it, we invite you to ask questions here in just a few moments, and I'll be happy to try and answer anything I can. And off air, if you ever want to contact me, Ashley would be more than happy to put us in touch. The other thing that is pretty significant is that if you own a qualified plan and you got a lot of money in that qualified plan, whether it's life insurance, equities, annuities, doesn't make any difference. It's creditor protected. So that means that if your client is a doctor, lawyer, Indian chief, you name it, and they get sued and they lose, nobody can get their hands on the values that are in their qualified plan except for one organization. Don't commit fraud with the US government. Okay. The IRS is the only one who can break the veil of creditor protection in a qualified plan. So as long as your family, friends, business owner, clients, whomever they are, get sued for any reason underneath the sun, they'll never be able to break the veil of creditor protection in a qualified plan. And employees who are looking at what their benefit programs are maybe don't understand the value of having life insurance from their employer paid for either by the employer's contribution or through a program the employers made available to the employees to be able to buy additional life insurance. So every place you look at, every business that you do business with, everybody you come into contact with, I don't care who they are they're a prospect. Whether they're a good prospect, that's up to you and your ability to ask the right questions and pique their interest and collect the data that we need to be able to generate some type of a proposal, which not only can you do by yourself, but I'm always willing to help make presentations, answer questions, and make discussions. If they want to bring their CPA or their attorney into the conversation, by all means, please do. A CPA is the person who taught me the pension business a very long time ago. She was one of the brightest, most talented people I know, and she really knew her business inside and out. And so I've worked with CPAs for years and years and years. I've done more CPE seminars for CPAs than I can shake a stick at. I've done national presentations for almost every financial uh, uh, organization in the country. I've done presentations for the National Trial Lawyers Association, for CPA associations. I've done CPE seminars in most states in the nation. I've done CPA webinars for as many as 800 people at a time. So CPAs are our friends. CPAs are our friends. They know who the people are that have the money that are paying the taxes. If you're not working with your CPA or other CPAs, I urge you to develop a relationship with them. Show them the things that you could do for them, because that's how I started. I went to my CPA and I said, hey, look, I'm in the pension business now, and what I'd like to do is try to find more people who have needs. Would you mind if I ran a sample proposal on your agency or your CPA firm? They agreed. I sold a plan. It's that tough. Most CPAs are number historians. They are not planners. Some are very good, but the majority of them are not. And when I talk about CPAs, what I suggest, if you are going to call on CPAs, you want to talk to the owners, to the folks that really control the clients that make the most amount of money, because there is where the opportunities lie. That's what we look for. We want to be able to get to those CPAs, introduce ourselves, show them the value added that we can offer their clients, and offer to do no cost webinars, no cost proposals. We do all kinds of things to help them move the process along. So just keep in mind all the different opportunities that exist out there that you may not be taking advantage of today. We happen to think that life insurance provides a very valuable fringe benefit to employees. With the ever increasing cost of employee benefits, buying life insurance inside a qualified plan can be a very cost-effective way to provide a valuable employee benefit. Qualified plans, life insurance, well, qualified plan life insurance is less expensive than group for many employers. Believe that or not. Buying life insurance inside of the qualified plan might be a better overall choice than relying on your company's group insurance alone. And by the way, what happens when you leave that company? Can that group insurance be converted? Some cases, yes, some cases, no. What happens if you get to retirement? What happens to that group insurance? Can you convert it? And if you can, at what cost? So the things you've got to take a look at is if you have the ability to buy the insurance inside of a qualified plan and you know what the cost is and you know what it's going to be worth when you retire, and you have the decision, do I want to keep the insurance in post-retirement or not? Okay. But buying permanent coverage inside a qualified plan can be far more cost-efficient way to pay for the protection that your clients need. The only cost to the participant is a small tax on the economic benefit. We used to refer to it as the PS 58. Okay, for those of you who've been in the business a long time. Excuse me. Now it's a different code section, but it's essentially the same thing. It is the net. It's the tax on the amount of net amount at risk, and so it's a small tax which you can recover at retirement against your taxes. All right, so you pay a little bit of tax on the economic value of the policy while you've got the plan in place, and at retirement you're going to get all of those dollars back with tax deductions in post-retirement. So there's just all kinds of different things we can do. Qualified life insurance is fully portable in the event of termination or of your employment or retirement. And it may be more affordable for retirees than group life, I can tell you that, depending upon the age of at retirement and the underwriting classifications used in the converted policy. You ever try to buy life insurance on somebody who's 65 or 70 or 75 or 80? It's not cheap. It's not cheap at all. So buying life insurance inside of a qualified plan, even if it were term insurance, if the prospect or if the client has reasonable amount of cash flow in post-retirement, to convert that insurance to some kind of permanent protection may be worth taking a look at. Okay, so what happens when you remove the policy from the plan? Well, you could terminate or just take the policy out, and there's going to be a taxable distribution of the net amount at risk. Okay, you could buy the policy from the qualified plan for the cash surrender value. Okay, so the dollars go back into the plan, the policy comes out. What's that sound like? Didn't I just talk about selling your policy to an irrevocable life insurance trust? A lot of times the challenge is, how do I get enough money into the irrevocable trust to buy the policy? All right. So it's the same aspect here. You could surrender the policy, give up the death benefit, just go ahead and take the cash and use it for whatever you're going to do in retirement. In some cases, you can exchange the policy. Depends on the carrier and the information inside of your plan documents. That's also an option. And selling the policy, again, depending on your needs, it is a option. There's certainly a lot of companies out there that are constantly advertising, sell us your life insurance policy. They're not doing it to be a good guy. They're doing it because they know if they can buy your policy, there's a chance they're going to sell it for a heck of a lot more money. So just keep that in mind when you think about it. Taking a taxable distribution. At the time the policy is distributed, taxes due on the fair market value less the aggregate economic benefit cost already declared as income. 20% of the taxable amount must be withheld for tax purposes. Any distribution prior to age 59 and a half may incur an additional 10% tax penalty. That's what we're here, folks. If we have one of your clients as a uh, pension plan person or has a insurance policy with us, we do all of these calculations. We let you know what is going to happen. We tell you what the tax exposure is going to be, and we try to find ways to mitigate that. All right. So again, working with a pension professional is always beneficial, whether it's us or some other firm that you're doing business with. You want to make certain that they're able to handle all of the issues that may befall your clients. Okay, selling to and buying from. Can you sell life policy to a plan? Sometimes. You can't do it in most defined benefit pension plans, particularly not in a fully insured defined benefit plan, but you can in some profit sharing plans, some cash balance plans or traditional defined benefit plans, but it's going to depend on what the plan document says. Okay. So you can plan to sell or distribute the life policy, but again, you need to understand what the rules are for the plan participant and for the family. And that again is where you need the pension professional to help you understand the ramifications of whatever decision that you would like to make or that you're thinking about making or they're thinking about making. All right. Insurance may buy the policy, or insureds, meaning the policyholder, may buy the policy for its cash surrender value and distribute the policy with zero tax effect, except for the difference between the cash surrender value and its current fair market value. We have folks out there who will do the valuation and come up with a fair market value. It's not free, but it's not horrendously expensive. It's something that you have to take into consideration. So prior to purchase, the policy cash value may be modified through loans or withdrawals and retained under the plan. Different ideas. I know I'm throwing a lot at you, but if you've been in the business for a good amount of time, you understand, hopefully understand most of this. So if you surrender the policy for its cash surrender value and retain the proceeds inside of the plan or roll it over to an IRA, depending on when the policy is surrendered, the policy may receive less than the premiums paid into the policy. It's an economic decision. This option is usually only taken when there is no longer a need or desire for the life insurance protection. Qualified plan exchange privileges. Again, whether your plan or your insurance carrier offers some kind of an exchange privilege, you just have to check with them to determine if that's even an opportunity. This offers a second chance to insure an attained age issue with no medical underwriting. Very few companies offer this today, but there are probably still a few out there. Reasons to include the life insurance are in a profit sharing plan, employers can purchase life insurance with pre-tax dollars using rollovers from other qualified plans like IRAs, Simples, SEPs. So what do you want to buy so where do you want to buy the life insurance? In a profit sharing plan? You can create a new profit sharing plan, fund it with rollover funds from your IRAs and other qualified plans, and then purchase or life insurance inside of the plan with tax deductible dollars. Plan life insurance saves the employee the personal premium expense. The life insurance premiums for life insurance issued in a qualified plan is being paid with annual contributions made by the business owner and usually not the employee, unless the business owner wants to provide life insurance as part of the plan design. Okay. So there's income tax-free death benefit proceeds. The net amount at risk, the face amount less the cash value, is income tax-free to the beneficiary. Excuse me. Large death benefits can be maintained even if a participant's salary drops in a defined benefit plan, because in defined benefit plans, we can use a participant's 3 highest consecutive years of earnings whenever they occur, for as long as he or she has been in the business, to calculate what the annual contribution is. If the business is a corporate entity, once the high 3-year average has been determined, the participant can take lower W-2 income in subsequent years and still maintain the same contribution level, which in turn maintains the premium and the death benefit of the life insurance. In profit sharing plans, life insurance can be purchased on spouses. If you have clients who have life insurance inside of the plan, check with the plan trustee and the documents or the TPA to find out if buying life insurance on the spouse is available. Okay. In a defined benefit plan, benefits are typically heavily weighted in favor of the older owner participant. A defined benefit plan is calculated for each participant based on their age, salary, and years to retirement. If the owner is older than the rank and file employees, the owner will receive a much higher percentage of the total plan contribution. And to be candid with you, most of the plans that we are brought to us usually have older owners, but not always. I sent in a proposal yesterday where we have 40 eligible plan participants. We have 2 owners, but we have a lot of people that make a pretty fair amount of money. So the question is, how are the owners going to benefit? Well, they're going to benefit in 2 ways. One, they're going to provide an opportunity for their high income earner employees to use some of that earnings to purchase family needed life insurance or for estate planning purposes. All kinds of ways. Don't ever turn down the opportunity to take a look at a company just because they don't have old owners and young non-owners. Take a look at the census, send it to somebody who can evaluate it and tell you what's the possibilities, okay? So again, that's another thing that we try to do. Here's a sample of male age 55, maximum contribution at age 65. Annuity only contribution is 279,000. But if he split funded it with life insurance, he could get a deduction of up to $465,000 and purchase $4.6 million worth of death benefit. I don't know. Am I crazy? If you've got a 55-year-old who's got the means to be able to spend this kind of money and he has a tax problem, would he rather get a deduction on 265,000 or 279? Would he rather be able to provide a $4.6 million death benefit to his loved ones, or to potentially pay estate taxes because he's built up such a large estate? Boy, the things that you can do. And yes, you make money off of it, but I always look at that as the side benefit. I always try to take a look at what are the good things that I can do because I was able to show somebody how to purchase insurance on a tax deductible basis and use that death benefit in the most efficient way possible to protect the family and potentially provide benefits down the road to their loved ones at a very bad time. Some of the reasons to include life insurance, well, the 412(e)(3) defined benefit plan permits larger deductions anyway, hence larger contributions for short service employees who are approaching normal retirement than defined contribution plans. If you have a 60-year-old making lots of money and can afford significant contributions, I don't care how much money he makes, we can only count the first $290,000 worth of his income. It's called considered compensation. That's the max. And you can put away what? How much can you put away for that person? $58,000? Or would you rather put away up to $450,000? And while the profit sharing plan may be desirable in some instances, which plan can you purchase more life insurance in? Which plan can provide for guaranteed lifetime income? So there are all kinds of considerations. And you don't have to be concerned with the policy becoming a modified endowment or having alternative minimum tax with qualified plan life insurance. The cash value in a life policy and a qualified plan is taxable. So it doesn't matter if the policy is a MEC or not. All right. So we try to cover all the bases. Life insurance in a qualified plan produces more leverage than life insurance under a split dollar plan. I don't know how many of you out there use split dollar. We do. In some cases, we recommend split dollar, if I say that thing correctly. Split dollars are a very valuable tool in the right situations. But if you have a choice and you can buy the insurance tax deductibly versus after tax dollars for split dollar, you might be doing your business owner client a favor. Okay. You at least ought to be able to present both options and say, would you like plan A or plan B? So I don't need to read all this stuff to you. In a profit sharing plan, you may be able to purchase key person insurance on a key employee or shareholders as a plan investment. Okay. Sounds kind of morbid, but it's a fact. You can purchase insurance on key people and provide for their families, as well as provide a better return to the plan in the event of a premature death. All right. A profit sharing plan may provide funds to purchase insurance when they need it for a buy-sell arrangement. You got any clients out there who need to do buy-sells? Most people do it with after-tax dollars. You set up a buy-sell agreement, you buy the insurance policies, you pay the premiums, you don't get any tax deductions. Okay. So just keep in mind that there's just all kinds of things that you can do inside of a qualified plan, particularly a profit sharing plan, that may help incentivize the business owner to do a buy-sell agreement and purchase the insurance that may be needed. So I'm at that time, Ashley, when people either like to go back to sleep or to ask some questions. So I'm going to open up the floor for any questions at all.
That sounds great. Thanks, Steve. And what I'm going to do is just go ahead and unmute the sound here for folks that have questions. Or I'm going to ask to unmute for those that would like to. And then does anyone have any questions that they might like to ask Steve currently?
One question.
Sure.
What kind of defined benefit is any specific kind of defined benefit will good for the sole owner of the small business to purchase the life insurance in their defined benefit?
Well, there are three types of defined benefit plans, and we operate on all of them. The one kind we discussed was the fully insured plan. That's under code section 412E3, and that's where we use life insurance and annuities to fund all of the retirement benefits, as well as purchase life insurance on the plan participants. That would have life insurance as one part of the plan and annuities as the other part of the plan. Okay, you've got to put the life insurance can't be more than 49.9% of the total contribution. We usually suggest you reduce that down to say 40%, because stuff happens. People's incomes go up and down. So say 40% life insurance, 60% fixed annuities can be a real good mix. The second kind of plan is just a plain old fashioned defined benefit pension plan, in which, once again, you can use life insurance. The difference here is that in a fully insured plan, you can only use a certain kind of life insurance. It's got to be a guaranteed cash value, guaranteed premium life product. It's got to be approved in the state in which your client is located. And the policy has got to have certain amendments on it that allow it to be used inside of a fully insured defined benefit plan. Same with the annuity. And Ashley and their team will provide you with all the different products you might ever need, and they can always come to me and ask me any specific questions if this plan or that plan of insurance would fit. The second kind of plan is called a traditional defined benefit pension plan. In that plan, you have the ability to not only use whole life cash value insurance, but you could also use universal life. You could use equity indexed universal life. You could use variable life. Okay. I'm not a big fan of variable life in qualified plans because I look at a qualified plan as the safety haven for putting money away so that your family and you know exactly what you're going to have and when you're going to get it. Use variable life outside of qualified plans, or use alternative investments. Qualified plans are the safe money, at least in my opinion. And then there's a third kind of a plan, which is called a cash balance plan. This is where we take a defined benefit pension plan, combine it with a profit sharing plan, and add a 401k plan in addition. These are great for successful small business owners where we may have a contingent of highly compensated folks, maybe some middle income folks, and maybe some lower paid folks. And if the census is of the nature, we can design it so we can push more of the contribution to the high income folks, still give some of the middle income folks some pretty decent benefits, and for the lower paid people, the opportunity to be able to participate in a 401k, typically with matching contributions. Generally, these are safe harbor type plans that we put in. But there are a lot of options when it comes to defined benefit plans.
So if the solo owner of his small business has 401k plan and defined benefit plan, that will be fitting on the third one, cash balance defined benefit?
Well, how many employees did he have?
One.
Just him.
Just him. Just her.
Yeah, I probably wouldn't. I mean, we could do a cash balance plan, or we could do a fully insured plan, depending on his how risky he is. Number one, if he wants all guarantees, the fully insured plan is probably the best option. If he wants to have the opportunity to invest money in other things, cash balance plan would be a very good option. And a lot of it also may fall down to what's going to give him the tax deduction he or she is looking for. Okay. We run them. Oftentimes will run two different plans for the same case, and let you and the client decide what's better for their particular situation.
Okay, so I think I probably will talk to Ashley and make a phone call conversation with you to decide which would be the best choice for my clients.
Sure. Well, what we can do is we can provide you with a census form. Ashley can provide you with a census form. You fill that out. It'd be pretty easy with just the one fella, because it's like name, address, telephone number, date of birth, date of hire, W-2 compensation, and desired contribution. And from that, we would prepare one or more proposals for you to evaluate with your client. And if you needed me on the phone to help make the presentation, I do it every day, all day. It's not a problem.
Yeah. The client just newly formed the defined benefit plan, so they already got the trust ID.
Okay.
So
if they haven't funded it yet, we can show them what the options are available to them, and whether it's just depending on what kind of a defined benefit plan they set up. We may be able to show them some new wrinkles with either a cash balance or a fully insured plan.
Okay, great. I would work with Ashley and then coordinate with her, and then we can help the client.
Great. That's what it's all about. In our opinion, we're here to help clients make good financial decisions, help the brokers help their clients make good financial decisions. Yep.